Well, the Chinese macroeconomic statistics on industrial production, retail sales and fixed asset investment that we previewed for last week are now due out on Monday the 18th, so keep an eye out for those. Economists will also pore over the latest so-called beige book that's due for release on the 20th to see what anecdotal evidence the US Federal Reserve is picking up on issues such as employment, wages, cost pressures and lead times. However, two items from the UK may just hog the macroeconomic headlines this week, and they are interconnected. The first is the latest batch of inflation data that's due for release on Wednesday the 20th. Petrol prices, heating bills, shrinkflation, the availability of staple foodstuffs in supermarkets, all hot topics across the country, and the latest official stats will be important for consumers, investors and central bankers. Just by way of reminder, for August, inflation came in as follows. The Bank of England's preferred measure, the CPIH index, which includes housing costs, rose 3% year on year. The Consumer Price Index rose 3.2%. That was the fastest rate since January 2012, and the jump from 2% in July was the biggest since records began. And the Retail Price Index, now cast aside by the Bank of England as an unofficial statistic, came in higher still at 4.8% year on year. Now, the Bank of England has suggested inflation could top 4% by year end, well above its 2% target, and stay there for some time into 2022. The Bank of England's new chief economist, Hugh Pill, has also come out and said inflation could come in higher than expected for longer than expected, rather puncturing the narrative that the current burst of price increases would be temporary or transitory, to use central bank speak. These figures could therefore help to shape the Bank of England's thinking at the Monetary Policy Committee's next meeting on the 4th of November. Remember that in September, the MPC voted 9-0 to leave interest rates unchanged at 0.1%, but only 7-2 in favour of leaving quantitative easing unchanged, perhaps the first hint of a shift towards a gentle tightening of policy. The second stat to note on the UK macro front will be the latest consumer confidence data from consultants GfK. This is due for release on Friday the 22nd. Remember that inflation is effectively a tax, as it erodes real terms purchasing power of the money in your pocket, especially if wage growth doesn't match or beat the rate of price increases. Throw in the government's 1.25 percentage point social care levy and panic at the pumps, and it'll be interesting to see if the post-pandemic recovery in consumer confidence is starting to peter out. The GfK survey's reading has already begun to weaken. The overall score dropped to -13 from -8 in September, and the major purchase index slid to -6 from -3. Further sustained dips could hint at a slowdown in consumer spending and therefore a hit to the economy. On the corporate front, the third quarter reporting season in the USA is now in full swing, and the pace is going to step up in the coming week on this side of the Atlantic too. Around a dozen FTSE 100 firms are due to release quarterly results or trading updates, and a few small and mid-cap firms are due to do the same. Names which may be worthy of further research include the following, although do note once more that these dates are subject to change, as was proven last week when ASOS released its results earlier than expected as it dished out a profit warning. So this week, in theory, we have BHP on Monday the 18th of October, Bellway on the 19th, when shareholders in Morrison's will get to vote on whether to accept the 287p a share offer from private equity firm CD&R. Then we have Antofagasta, Segro and Avast on the 20th, Unilever, Anglo American, Renishaw and Spectris on the 21st, and then London Stock Exchange and Intercontinental Hotels on Friday the 22nd. But the company which could just cause the biggest fuss in the week ahead is Barclays. The bank is scheduled to report its third quarter results on Thursday the 21st of October. Shares in Barclays have almost doubled over the past 12 months, easily outstripping the FTSE 100's near 20% gain over the same period. And this return to favour with investors could be down to several factors, including an economic rebound in 2021, which has helped Barclays write back some of the bad loan provisions it took in 2020. Perky financial markets, which have helped the investment bank to perform strongly, a return to the dividend list, the commencement of share buybacks, and ultimately the lowly valuation at which Barclays shares traded a year ago, to reinforce the worth of the old saying that you can have cheap stocks and good news, just not both at the same time. Barclays has already showed a strong profit rebound in the first half of 2021, recording pre-tax income of around £5 billion against just £1.3 billion in the same period in 2020. Further year-on-year improvement seems likely in the third quarter, when Barclays made £1.1 billion a year ago. After a glance at that headline figure, analysts will then look at four key factors behind that profit growth. The first is loan growth relative to deposit growth. Deposits growth has been outstripping loan growth since Q1 2017. But a more encouraging indicator for consumer confidence and the economy would be if that trend starts to reverse, and it might help the bank's profits as well. On that theme, the second key trend is net interest margin. High interest rates, or at least wider credit spreads and steeper yield curves, would help Barclays here. And in the second quarter, the net interest margin at Barclays UK was 2.55%, pretty much flat on Q2's 2.54%. So maybe that's finally starting to stabilise. The third factor is loan provisions. In 2020, Barclays took heavy provisions in the view that a recession and the pandemic would hit its customers' ability to pay interest on their loans and then repay those loans. Those fears have yet to be fully borne out. Having taken £3.7 billion of loan provisions in the first half of last year, Barclays wrote back £742 million of those in the first half of this year. In the third quarter last year, the bank took further charges of £608 million. Finally, analysts and investors will look to the performance of the investment bank. Activist investor Edward Bramson of Sherborne Investors didn't get very far with his calls to spin off the unit and break up the group, not least because it actually had a pretty good first half, generating £3.4 billion of pre-tax profit against £2.2 billion in the prior period in 2020, helped by active bond and equity markets, plenty of primary and secondary equity market activity, and a good dollop of merger and acquisitions activity on top. Barclays is not likely to talk about dividends, as that tends to be a topic for discussion at the first half and full year stages, but it has launched 2 share buybacks this year with a combined value of £1.2 billion, so watch out for any comment there. And finally, shareholders might be looking for any steer on Barclays' leadership. There have been hints that boss Jez Staley may leave by the end of this year, especially after a reshuffle of top management divisions and heads at this time a year ago. I hope that you and your families are all in good health and good spirits. Thanks for listening, and I look forward to talking to you all again next week.